So, quick question. Let's say the IRS is knocking on your door and wants to see your documents. Are you going to go ahead and hand them over a shoebox full of receipts, or are you going to hand them some nice, clean record books? Okay. Today on Tea on Taxes, I'm going to go ahead and talk about what really matters because one is going to protect you and one is just going to go ahead and clutter up your desk. Now, for example, right now, you probably have receipts everywhere. I mean, you've got them in your car, you've got them in your purse, you've probably got them digitally on your email, and you swear that you are going to go ahead and organize them someday, okay? But tax season comes around and the panic is setting in, and you're like, oh my God, what does the IRS actually want to see with all of these things? Okay, so let's clear this up. Receipts are not the whole story. The truth is that receipts don't prove much without records. And that's where most people are tripping up, especially during their audits. So let me clear this up. Receipts are not records. Records are detailed explanations. They show where your income is coming from and where your expenses are going to in your business. That's why it's important to have a record of all of your transactions, both incoming and outgoing with your business, because the record tells the whole story. They connect each and every receipt that you have to an actual transaction, date, and its purpose in your business, which is the most important. And that's what the IRS is using to verify the accuracy of your documents and the validity of your expenses as well. It's not just the receipt itself, because you could have a $100 Michael's receipt, but that doesn't really say what it was for. So unless in your records it says that $100 purchase at Michael's was for craft supplies, it means nothing. It does not show that it went towards your business. You could have gone to $100 for Michael's for Halloween stuff, okay? That's why it's important to keep those records. And it also needs to make sure it has the date and, of course, that purpose. Usually, like, the purpose would be supplies, and you would have the date like March 15th or something. Now, everything doesn't need to live in your binder. You don't have to put all those receipts and keep all of those receipts in those binder with your records, okay? You don't have to do that. You want to keep the receipts that are tied to your business expenses. You can scan them because the IRS does take digital receipts as proof. You can scan them, you can copy them, whatever works for you. But you want to keep business receipts, charitable donations that you may do for your business, and any large purchases, especially large purchases. You want to go ahead and keep those records. Now, let's talk about record keeping for a little bit. How long do you keep your records? Now, for businesses, and I'm talking about businesses only, you want to keep your bank statements, sales reports, and also like your mileage logs, at least for 3 years, because that's usually the ground, like 3 to 4 years is usually the ground where the IRS is auditing. Okay. You also want to go ahead and keep all of your documents for 7 years. If you have any claims of loss from bad debt or from a worthless security, you want to go ahead and keep that as well. And also, if you're claiming losses, you want to go ahead and all your documents for at least 7 years from the date of filing. Now, there's things that you want to keep forever, and those are going to be like your property asset records. And of course, while you own them, you want to keep them pretty much forever. And that's where you're going to hold on. And now you don't need to keep every coffee receipt, but the records do show a clear picture of your business activity. Okay, now again, digital is totally fine because the IRS will accept any digital copies as long as they are accessible. So you don't want to put it in some proprietary format. You want to make sure it's in a common format that anybody can pull up, like PDF, JPEG. So one of the big things that people mess up on, again, is unmatching their receipts. You want to match your transactions to your bank statements at least monthly, whether you're doing that on your own through Excel or through Wave or some other program, or you're doing it through QuickBooks. You want to at least match your transactions with monthly, at least with your bank statements. This will make it a lot easier towards tax time. And then you want to make sure that when the categories that you have for your statements, for your transactions are consistent with common names, especially if you keep it to the Schedule C, that will make it very easy. So things like supplies, utilities, entertainment, advertising, those types of things, those are also on the Schedule C. As long as you keep it within that, you're fine. Because when the IRS sees consistency, they see credibility, and that is the secret. So just some closing thoughts. Receipts are your proof, but records are your story. And that is what the IRS reads first. So keep that in mind. And you want to make sure that you want to keep them neat, consistent, and connected to any of your receipts. So that way you never have to panic during audit time. I hope this cleared up that confusion. Please hit that like button and hit subscribe to follow more Tea on Taxes. I definitely try to get this in every Tuesday. Next week, I'm going to take you into my home office and just kind of show you exactly what the IRS is looking for as well. And can you really deduct that home office? Just make sure you go ahead and tick that bell so you can get notifications when that posts next week. Bye.